welcome to today's episode in which we're going to discuss forecast contracts in the context of global climate and the application of insurance. Joining me to discuss is Patrick Brown, who joined the IBKR team earlier this year. Welcome, Patrick.
Thanks a lot for having me.
You're very welcome. Let's get straight into it. How can an organization use a forecast contract in a way similar to a disaster insurance contract?
Yeah, so just, I guess, backing up for a second, prediction markets have long been recognized for their ability to provide information by aggregating and representing the collective wisdom of the crowd, where the crowd is typically represented by speculators seeking to profit on their own unique insight. But there are a bunch of applications of prediction markets that tend to be less discussed, that are more directly applicable to those actually participating in the markets. And so one of the clearest examples of that is the hedging of financial risk to weather or natural disasters, so akin to disaster insurance contracts. And so at ForecastX, they're offering various prediction markets for natural disasters at a local scale, such as will a major hurricane make landfall in Miami-Dade County in 2025? And as you can imagine, there's numerous organizations that would face broad exposure to such an outcome that they might want to insure against. So those would include things like utility companies, commercial and residential real estate owners, businesses with a bunch of franchises in the area, say theme parks, municipalities, and insurers and reinsurers themselves. And so for these organizations, buying a large number of yes contracts on a disaster strike like that event question would mean a large payout immediately after the event occurs. And so this is very similar to purchasing what's called parametric insurance, which is triggered by weather parameters like recorded wind speed, as opposed to the type of insurance we're all more familiar with, which is called indemnity insurance, that covers the direct demonstrable financial losses that an organization would occur. So do you mind if I give you just an example of how this might work?
Go ahead.
So let's imagine that the true probability of a major hurricane making landfall in a given county, say this year, is 10%. So that would mean that for a forecast contract, the price of an initial yes contract would be listed at about 10 cents. And so let's suppose you're an organization with exposure to that event and you want, just to throw out a number, let's say you want 10 million in coverage, should that occur. Then buying a yes at 10 cents would pay out $1 for each contract for a net of 90 cents per contract. So if you wanted a 10 million net payout if the event occurred, the organization would have to buy a little bit over 11 million yeses for a little bit over $1.1 million. So then if the event occurs, then you net 10 million. And if it does not, the yeses are worth nothing. So you lose $1.1 million. And so this is roughly analogous to an insurance arrangement where the organization paid 1.1 million in premium for 10 million in coverage, though the cost of the insurance is all paid up front. And I should note that for simplicity, I'm making these numbers round. And so this example ignores the additional attributes that would change the numbers slightly, one to the disadvantage of the participant and one to the advantage. So to the disadvantage is that ForecastX charges a fee of 1 cent per each pairing of yes and no contracts. But to the advantage, ForecastX also invests the collateral and passes all of that back to the members each month, which can be used as an incentive coupon. So for interactive brokers, the incentive coupon is currently at 3.83% annualized rate, which accrues daily on the dynamic market price of the contract and then is paid out monthly. But that's the general idea of how that would work from the perspective of someone wanting to hedge the risk.
Gotcha. Okay. Since forecast contracts resolve based on a simple yes or no event trigger, they seem to share a lot of characteristics with traditional parametric insurance. Is that correct?
Yeah, so there's shared advantages and shared disadvantages. So the most commonly discussed advantage of parametric insurance is just the fast automatic payouts that they occur almost immediately after the event takes place. So that's in contrast to indemnity insurance, which is going to involve claims paperwork and loss adjustment that can be negotiated for very long periods of times and very long period of a very long period of time and cause delays, even months or years after the event occurs. And this is especially true after major natural disasters. Like we saw this during Hurricane Harvey, where claims adjusters are essentially overwhelmed. The other main advantage of parametric insurance is that it entails very broad coverage with no strings attached. If the event occurs and you get $1 per contract, the money, of course, can be used for anything the organization deems appropriate. So you can cover less tangible risks that are not nearly as quantifiable as just physical damage. So could cover general business disruption or supply chain disruption, lost tourism, lost property values, lost tax base for public entities. And so these speed and flexibility aspects, I think, would be especially appealing to public entities like municipalities, especially if they're interested in allocating funds for like immediate disaster relief efforts in any way they deem necessary. Another kind of advantage is that it would eliminate concerns about relying on political systems. So you don't have to hope and wait for the federal government to declare a state of emergency in order to mobilize resources. You would just get those funds no matter what. So disadvantages though, the main disadvantage of parametric insurance is referred to as basis risk, which is essentially the mismatch between the payout that you would receive based on the weather parameter and the actual financial losses that are incurred by the organization. If a storm strikes just outside the defined region or falls slightly below the strength threshold, the contract would fail to trigger, even if the buyer suffers losses. But it's important to note that basis risk cuts both ways. So an organization could emerge relatively unscathed from a disaster that did trigger a yes and still receive the full yes value, of course. And I think it's important just to note that basis risk is a lesser issue for entities with broad exposure across a region. So local governments or insurers or reinsurers are more likely to find that trigger to be representative of their losses. But nevertheless, I think entities would generally consider any type of parametric insurance as a complement to other forms of indemnity-based insurance and not a replacement. And so forecast contracts would probably be viewed the same way.
Patrick, why might somebody buy the no side of the contract?
So first, I think it's important to point out that no's could be viewed as revenue downside insurance for a lot of entities. So no's themselves could be insurance. So this would be things like retailers like Home Depot or Lowe's, anything that's going to provide services during a disaster. Roofing, siding, and window contractors, restoration and remediation contractors that deal with water damage, mold cleanup, debris removal, that type of thing. So that's one thing, is that no's could be considered insurance themselves. But more generally, the buyers of no's would include basically anyone interested in receiving the risk premium offered by those purchasing the yeses. So if we go back to our previous example, where the true hurricane landfall probability is 10%, let's say that the yeses get bid up to, instead of 10 cents, 20 cents. And that's because organizations are willing to pay a premium to transfer risk off their books, which of course they are, or insurance would not exist. So essentially, it's those looking to hedge the risk are bidding up the yes prices, which is inherently pushing the no's down. So no's become undervalued or they go on sale. So in our example, someone could purchase a no at 80 cents when it's really worth 90 cents. And that means on average, that person would receive 90 over 80 is 12.5% of a return. And that could be in a very short time. If we're talking about hurricanes, that could be purchased, say, in July and it expires in December. So 12.5% return in 6 months. And the idea is this strategy could be scaled as well. You purchase a suite of undervalued no's that are uncorrelated with each other. That provides a way to achieve relatively high returns that are likewise uncorrelated with the broader business cycle, with mainstream equities and bonds. And so you could almost consider these no's as an asset class in and of themselves that diminishes volatility and downside risk of a broader portfolio. So we've seen hedge funds, pension funds, sovereign wealth funds, and even university endowments interested in catastrophe bonds for these same attributes. Another entity that might be interested would be any type of like impact-driven investors, like ESG-oriented funds or climate resilience funds, that could argue that investing in those provides the capital that facilitates climate resilience while still delivering a relatively good return. And the really interesting part about this is that those are all institutional investors, but Interactive Brokers would allow retail investors as well to purchase these notes. So it's basically anyone interested in receiving the risk premiums for taking on the fractional exposure of some disaster risk can participate.
Patrick, is there enough liquidity at present to use forecast contracts in this way?
Yeah, so these markets do require broad participation to function effectively for this purpose. And that's why Interactive Brokers is working to raise awareness about the utility of these contracts for this purpose. So right now, there's not a lot of participation, but we hope that getting the word out will increase liquidity rapidly. In the meantime, though, there is a first mover advantage to these markets because newly emerging markets with low participation are certainly more likely to be mispriced, which represents a greater opportunity to capitalize on these mispricings and generate profits early on.
To Patrick Brown, Head of Climate Analytics at Interactive Brokers, for joining me today. Thanks, Patrick.
Sure. Thanks for having me.
And to the audience, don't forget to subscribe wherever you download your podcasts from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures, event contracts, and forecast contracts are not suitable for all investors. Before trading these products, please read the CFTC risk disclosure. For a copy, visit our warnings and disclosures page. Interactive Brokers LLC is a CFTC-registered futures commission merchant and a clearing member and affiliate of ForecastX LLC. ForecastX is a CFTC-registered designated contract market and derivatives clearing organization. Interactive Brokers LLC provides access to ForecastX forecast contracts for eligible customers. Interactive Brokers LLC does not make recommendations with respect to any products available on its platform, including those offered by ForecastX. Forecast contracts are only available to eligible clients of Interactive Brokers LLC, Interactive Brokers Hong Kong Limited, and Interactive Brokers Singapore Pte. Ltd.
This is commentary on economic, political, and/or market conditions within the meaning of CFTC Regulation 1.71 and is not meant to provide sufficient information upon which to base a decision to enter into a derivatives transaction.